This is the Real Estate Rookie Show, number 12. I am Ashley Kerr, and I am here with my co-host, Felipe Mejia, who has been bombarding me with text messages about his new Tesla he's going to buy. So I'm calling him out right now, and he's got to set a date that he actually buys it because I'm sick of listening to him say he's going to buy it. So when's that date, Felipe?
I can't get my life together. I'm trying to figure out how I can afford a Tesla. I know I can. I just am trying to figure out how it's going to work into my portfolio because it's just way out there. And I'm like, I just want to buy another rental property every time I have the money to buy a down payment on a Tesla. So anyways, that's really hard.
Keeping that money is so much sweeter than spending it.
Gosh, just putting it into a rental property makes it so much easier. That has nothing to do with today's show. Today we have Jay Scott, the legend, the
VP legend. Yes,
that's absolutely right.
Someone was telling me that he has the most forum posts ever on BiggerPockets. That is crazy.
Man, he must really know what he's talking about. Not just that, he wrote the book on flipping houses, rehabs, and he just recently, not recently, but he wrote a book.
Last year. Yeah, Recession-Proof Investing, and he
talks about that book as well.
And he also hosts the business podcast for BiggerPockets too with his wife, Carol. And that is great if you guys haven't listened to that yet. Jay is kind of going to break down just economic cycles, what's happening right now, how you should invest in a downturn. And I think he does a very good job of kind of breaking it down for rookies, for beginners. You know, even for me, I still don't have a great grasp on understanding economics. Definitely not to the level he does.
Yeah, I mean, he breaks down the economy and the cycles that it goes through, the business cycles it goes to. And if you have real estate, you have a business. I mean, ultimately, that's what he's doing. And he breaks it down on how he's reading it or what he thinks is going to happen, right? He gives us a little snippet into his mind.
Yeah.
Good guess, like he calls it. A good tip on HELOCs, on what to do with lines of credit. And I mean, he gives really good tips in this episode.
And we get a Jay Scott exclusive too. He's never been interviewed on this before. So you'll have to find out as we dig into the interview what that thing is.
That's right. Out of all the podcasts, he finally gave one thing on here that he hasn't gave to anyone else. So with that, let's bring out Jay Scott. Jay Scott, man, thanks for being on the show. Super excited to have you here, man. How are you?
I am doing well. I'm thrilled to be here. This is the One BiggerPockets podcast I haven't been on yet, so I'm really excited. Thanks for having me.
I know we have like a celebrity on today. This is so exciting. So what we're going to talk about today, at least start off, is we want to, you're a huge economics guy. I've learned a ton from you just about with coronavirus and what the economy is doing and a recession. So today we want to focus on breaking that down for everyone, including myself. What does, a rookie investor need to know about the different cycles? So do you want to start us off with kind of talking about there's three major cycles that you go over, correct?
Well, let's start actually a little bit earlier than that because it's interesting. I've talked to a lot of people over the last, especially over the last month or two, but over the last couple of years. And what I realize is there are a whole lot of misconceptions about the economy and how it works. And that's not surprising because things have been a little bit weird since 2008. Everybody remembers the 2008, the big recession, and things have been a little bit different since 2008 than what we typically see in the economy. So for all of those investors and all of those people that have just kind of started paying attention over the last 10 years or at any point during the last 10 years, what you might be seeing is a little bit different than what the economy has given us over the last 150 years. So to step back to the very beginning, so basically we have an economy, and the economy is essentially just all the transactions that happen in our society. So every time you buy and sell something, that's the economy. And there are points in our economy where things are going really well. People are making a lot of money. People are spending a lot of money. Businesses are making a lot of money. Wages are going up. Everybody's doing well. And we think of that as kind of an economic boom. And then we have those times where it's just the opposite. So businesses aren't doing well. People aren't making a lot of money. We're seeing layoffs. We're seeing just people spending less money. And we typically refer to that as a downturn or a recession. So throughout the history of this country, we have these economic booms and we have these recessions. And so what a lot of people don't realize is if you look back, let's go back 150, 160 years, there are very, very clear patterns to how these booms, these up economic times and these recessions play out. And typically speaking, over the last 160 years, we've had about 33 different cycles or 33 cycles where the economy has gone from down to up, back to down. So a full cycle. And if you look, it's actually been fairly consistent. We tend to see that economic cycle play out about every 5 to 7 years. So if you go back before 2008, most people that were paying attention to the economy realized that every 5 to 7 years, you would kind of have this uptick in the economy, and then you'd have this recession, then uptick and a recession. And I'm probably a little bit older than a lot of the listeners out there. I'm in my mid-40s. And so I kind of remember back before 2008, I remember these recessions. I remember things getting good and getting bad and getting good and getting bad. And then 2008 comes around. And 2008, we have this massive downturn, something that we hadn't seen, and very few of us had seen in our lifetimes, unless you were around back in the 30s. There was in the 80s, we had a couple big crashes, but it wasn't like 2008. 2008 was kind of the worst of it. So after 2008, we kind of got on this trajectory. Things started getting better. And between 2009, 10, 11, and 2020, our economy just kept going up. So for a good 8, 9, 10 years, our economy has just been going up. And like I said, typically speaking, we see a full cycle, an up and a down over 5 or 6 or 7 years. The fact that we had 8 or 9 or 10 years of just an up economy since 2008, that was somewhat unprecedented. So anybody that started investing after 2008 probably thinks of the economy as it just goes up. And yeah, we have the 2008 type events where it goes down, but those don't happen all that often. In reality, those do happen pretty often. We do tend to see those recessions. We tend to see them every 5, 6, 7 years. They don't tend to be as bad as 2008, but there are ups and there are downs. So the first thing to understand about the economy is what we've seen, the fact that we saw 10 or 11 years of the economy going up, what we refer to as an expansion in the economy. The fact that we saw 10 or 11 years of that is absolutely unprecedented. That was the longest economic expansion in the history of our country. So the fact that obviously the pandemic that we have now, that nobody could have predicted, or very few people could have predicted. That was what we refer to as a black swan event. So pretty much unpredictable just based on all the other data. The fact that we had that, yes, that took us all by surprise, but it shouldn't surprise anybody that after 8 or 9 or 10 years of an economic expansion, that we were going to see a downturn at some point soon.
And I have heard a lot of investors talk about that they think a recession is coming. You know, maybe they're hoarding money. What does all this have to do for a real estate investor? For our rookie listeners, what does this matter to them?
Yes, so certainly because we have economic cycles. These economic cycles typically, we look at 2008. 2008 was a real estate crash. It was a crash in the lending markets. It was a crash in the real estate markets. So another big misconception that I think a lot of investors have is that when we have an economic downturn, when we have a recession, it means we're going to have a crash in real estate prices. I know a lot of people who for the last 6, 7, 8, 9, 10 years have been saying to me, I can't wait till the next recession so I can pick up real estate at half price.
Yeah, I've heard that a lot too.
Exactly. Well, here's the thing. Typically, recessions aren't driven by real estate. Typically, it's not a real estate crash that causes a recession. 2008 was definitely the exception. 2008, again, the lending industry was really bad. The mortgage industry was really bad. Real estate was having some fundamental issues that led to the 2008 recession. Historically, real estate doesn't cause the market to crash. Real estate doesn't cause a recession. If you go back to 2001, it was, anybody that was around then remembers the internet boom, where basically internet stocks were through the roof, and then 9/11. 9/11 caused the recession in 2001. If you go back into the late 80s, early 90s, there was this thing called the savings and loan crisis, which was basically a lending recession, but outside of real estate. You go back to the 70s, it was oil. You go back to the 30s, like the Great Depression, and it was things like tariffs and it was debt. All these things that contribute to recessions. Very rarely does the same thing cause a recession multiple times. And so the fact that we saw real estate cause the 2008 recession, there are a lot of investors out there, especially new investors, who had this assumption that when the market goes down, when the economy goes down, real estate's going to crash. Now, it might. There are definitely some recessions where real estate takes a big hit. And that makes sense because if you think about it, what causes a recession? People are unemployed, people's wages are dropping, people's hours are getting cut, they can't afford to buy stuff. So all those things are certainly going to spill over into the real estate market. If people are losing their jobs, they can't buy houses. If they're getting their hours cut and their wages cut, they're not able to make their mortgage payments. So all of those things are going to affect housing, but not every recession is going to have a huge impact on housing like 2008 did. Some will, some won't. There are a whole bunch of and nobody really understands or agrees with what exactly causes housing to react to a down economy and how bad. So yeah, it's likely that we're heading into a recession now. Obviously, we're in a recession, but it's likely even when the pandemic, when the lockdown ends, we're still going to be in a recession. But don't assume just because 2008 the stock market or the real estate market crashed, that in 2020, that recession is also going to result in the real estate market crashing. It might not, but it's important to realize that we don't yet know exactly what the next recession is going to have, what type of impact that's going to have on real estate. Likewise, the recession after that and the recession after that, it's unclear if each of those recessions is going to impact real estate, not much, a little bit, as much as 2008, or maybe even worse. We don't know.
Quick question though. So because I know this is what I would be asking, so I know that our listeners are going to wonder, well, if the economy is so measurable, you could say, you can measure, you can almost get it down to a couple years of when it's going to be up and down. Why are so many investors and people, frankly, why are so many people not ready for something like this? If the information's out there, the data's out there, this has been proven over a couple hundred years now based on your book. So why aren't people more prepared for this?
There's a couple reasons. One is that a lot of people in our industry, in the real estate industry, and investors in general, a lot of them are younger, and they haven't been through multiple cycles. Or even if they've been through multiple cycles, I've been through probably a dozen cycles in my life, if I think about it, maybe not that many, but I've been through a lot, but I didn't really start paying attention until 2001. Like for me, that was kind of like I was late 20s and early 30s, and I'm like, oh, this economics thing is interesting. Oh, and real estate prices are going down. I was looking to buy a house back in 2001. I just moved to California. And so for me, like paying attention to the real estate market and the industry, it was the first time it ever occurred to me that, oh, I guess this is what a recession is. It had happened to me before. It had happened in the 90s. It happened in the late 80s. It probably had happened in the 70s when I was a kid, but I never paid attention. So until you start paying attention, it's going on around you, but you're not really seeing the big picture. And very few people actually look at the data and say, okay, I can measure 160 years back, 33 recessions. It happens every 6 or 7 years. Again, most people, it's just kind of like, I guess it happens every once in a while, but they don't know if it's every 5 years or 10 years or 20 years because they don't see that big picture. Second thing is a lot of people have very short-term memories. I remember coming out of 2008, I mean, it was probably 9, 10, 11, and people were to some degree psychologically scarred. They were terrified to invest a lot of money. They were terrified to flip houses, even though the market had started to recover. What they saw in 2008 scared them so badly that they were just like, wow, this could get really bad again. I'm scared to invest. And then here comes 2013, 14, 15, 16, markets going up, stock market's at an all-time high, people are making tons of money, flips are going crazy, all these investors are coming out of nowhere, and suddenly people have forgotten those lessons of 2008. They've forgotten that this can get really bad, or even if not really bad, this could certainly get worse than it is, and so people just kind of They don't remember. And then the third piece is just this term, we use this term irrational exuberance, which is people just kind of feed off everybody else's excitement, everybody else's thoughts and ideas. And when nobody's talking about the market potentially going down, or not a lot of people talking about the market potentially going down, everybody starts feeding off that whole excitement of, I've got to buy more properties, I've got to start building, I've got to buy multifamily, I've got to do this, I've got to do that. And it's just, people don't tend to think for themselves. They tend to listen to those around them. And when a lot of people are really excited, everybody else gets excited, and it just kind of snowballs.
I can definitely relate to the first one there, being oblivious that it's actually going on, because I was in college in 2008. And I mean, I was living my own recession on, ramen noodles and hot sauce, but I had no idea that it was, going on around me. And as I got older, I learned more and more, and now I like to learn about it and study it. But this is definitely, if we are coming up on a recession now, this will definitely be a learning experience and something I want to, take in as much as I can from it and learn from it.
Quick question. So how should somebody prepare for the recession coming, and should they be preparing differently as recessions are coming in their lives? Like for the 2008, should they have prepared a different way, or do you think there's like an overall way to prepare for something like this?
That's a really good question. So let me take the second part of that question first, which was, should we be preparing differently for different recessions? Typically speaking, nobody knows when a recession exactly is going to occur. Like I said, we know they occur about every 5 to 7 years, but not always, obviously. We saw that this one lasted 10 years, this 11 years before this one ended. And if we hadn't had this pandemic, who knows, it could have been another year or 2 or 3. So we do see certain similarities in the cycles and in the recessions. Some of the things that characterize a recession are the total output of the country, like just the total output of the businesses. We refer to that as gross domestic product. It's the total amount of products that the companies are making and people are buying and transactions that are taking place. During a recession, that drops. So fewer transactions. People aren't buying as much. Companies aren't selling as much. Unemployment tends to go up. That's another thing that we see consistently throughout every recession. Typically, going into a recession, we see interest rates rising. That's kind of common. Didn't happen this time, but typically we see interest rates going up leading into a recession. That's actually one of the things that leads or causes a recession. We typically see people's wages falling. So businesses are cutting hours and they're cutting salaries. So these are certain things that we see in every recession, but we never know exactly when it's going to occur. We can start to see these things, and it could be 6 or 12 or 18 or 24 months before we really see a downturn. So yeah, it may be possible to predict a recession within a year or two, but it's hard to say next week a recession is going to start. And then secondly, it's impossible, nobody's been able to consistently do it, to say how bad a recession is going to be. Because typically what happens is in a recession, there's one, people like to refer to them as bubbles. So there's some thing that's completely out of whack, and when that breaks or when that bubble bursts, we see the downturn. And that's actually, it's pretty true. It's not always true. Sometimes there's a whole bunch of little things that break, but a lot of times there's one big thing that kind of breaks. The question is that one big thing breaking going to lead to a whole bunch of other things breaking? So in 2008, yes, it was the mortgage crisis and the lending markets. And when that broke, that kind of broke everything. I mean, that rippled down into lots of different markets, lots of different industries, and everything sort of broke. You look at 2001. 2001 was a good example as well. We had the internet boom, and we had 9/11. And so the bursting of the internet bubble, where all the internet stocks went down, that was a big economic hit for a lot of people. The stock market took a big hit, and then 9/11 caused a big ripple throughout the airline industry and tourism, and a lot of other industries got hit because of 9/11. So you could have thought that in 2001, kind of that those two big things happening could have led to a domino effect of a lot of other things happening. It didn't. But in 2008, the mortgage crisis actually did lead to a domino effect. So we never know what that domino effect is going to look like, if it's going to happen. And so without knowing if there's going to be that cascading effect throughout multiple industries, we don't know if a recession is going to it's going to be a 3 months, we're going to lose some jobs and it's going to be not fun, and then everything gets back on track, or things are going to get really bad and it's going to be like 2008 or like the 1930s. We don't know. So let's start with those two big things. If anybody tells you they know when a recession is going to occur or how bad it's going to be, they're either trying to sell you something or they're just deluding themselves. Now, second question, how do we prepare for that? Number of ways we can prepare for that. So there are certain things that characterize different parts of the economic cycle. So we have that uptick in the cycle, we have that downturn in the cycle, we kind of have the top part of the cycle as well. And through each of these phases of the cycle, of the economic cycle, there are different things that are kind of happening around us. So one of the big ones, and one of the things that I've been talking about a whole lot the last few weeks, has been lending. And since 2008, money has been cheap. There have been hard money lenders out there willing to offer rates at like 9 and 10% these days, which is crazy. Anybody that was investing back in 2008, 9, and 10, they remember hard money rates at like 16% and 5 points. So the fact that we're seeing hard money at like 9% is just ridiculous. Big banks are lending to people who have credit scores of 560 or 580 or 600. Again, go back to 2008 and you needed a 720 or a 740 credit score to get a loan on a house. Private money. Everybody and their brother has money in their IRAs now, or just money sitting on the side that they're looking to do something with. And they're investing in multifamily, they're investing in flips, they're investing in people's rentals. All this money is out there. And if you didn't go through 2008, you probably don't realize it, but during a downturn, lending gets really tight. People are scared to invest their private money. Banks are scared to invest their money. Hard money lenders can't get money from their bigger investors to invest. So we start to see a lot of tightening in the lending markets. And we've started seeing that over the last month or two. And there are a whole lot of people that are coming to me saying, I didn't expect it to be this bad. I knew that things would get bad and I was hoping I'd be able to buy deals, but I was still relying on being able to borrow money to buy deals. And now I finally believe you that during a recession, it can be really, really hard to find money. So one of the big things that I like to tell people, and a lot of investors who've lived through multiple recessions like to tell investors, is that leading up to a downturn, and again, we don't know exactly when it's going to happen, but if you can kind of time within a year or two of when it happens, that's the time to start saving your cash, to start cashing in those properties that you think you'd rather have the cash in your hands than be holding the property. It's a good time to be working on your credit. It's a good time to be taking out new credit lines like a HELOC. You don't necessarily have to take that money out, but open up a credit line so you have access to that money. And
what if the bank closes? What if the bank closes one of those lines of credit while you have it?
And that is certainly a risk. And so one of the things I've been telling people since March, when we started to see this economic shift or this economic catastrophe, is that there are banks out there that could start to close these credit lines. And so for some people, I've actually suggested, and this is not a blanket suggestion, these are very individual targeted suggestions I made, but for some people who knew that they were going to need access to cash for some specific expenditure, maybe they had to make payments on a refinance, or maybe they had to be able to cash out a hard money loan. For those people that had very specific needs for money over the next 6 months, what I was recommending to them is pull as much money as you can out of your HELOCs, pull as much money out of your other lines of credit as you can, and just stick that money in the bank. There's less chance of a bank closing down a credit line or decreasing your credit line if you've actually pulled that money out. So it's no fun paying interest on that money if you don't use it, which is why I don't necessarily recommend this strategy to everybody. But for some people who know they're going to have a specific need for their lines of credit in 3 or 4 or 6 months, I'm actually recommending take that money out now, stick it in a bank account, pay the interest for a few months, just throw away that interest so that you know that money is available in 6 months. Because one of the things that we tend to see during a bad recession is that banks will start to close down credit lines, or they will shrink the credit lines. If you have a $100,000 credit line and the most you've ever borrowed on it is $20,000, they might shrink that credit line down to $20,000. So definitely that's always a risk. So, and that's another reason why it's always good to have as much cash on hand as possible. We've all heard the phrase cash is king. Well, during a recession, cash really is king, because those who have cash during a downturn are going to be much better positioned to buy properties. We hear all the time, everybody out there, there's 10 million investors out there waiting for the real estate market to collapse because they all want to go out and buy real estate at half price. Well, how many of them have the cash to do that? How many of them want to do that, but because they don't have the cash and because lending is tightening, they're not going to be able to do that. So cash really is that thing that gives you the ability to take advantage of the opportunities.
I want to touch back on the line of credit real quick, because a couple episodes ago, I think it was episode 7, Felipe and I talked about balloon payments and explained that to everyone, where it's when, you have a mortgage or a loan on a property and on a certain date, like a large balance is due on that. So with that line of credit, that would be a good advice, is to, pull that money off your HELOC if you have a line of credit, or if you have a balloon payment due coming up, so you have that money available. And Felipe, did you have that? You have a balloon payment coming up, correct?
I did. I had an ARM on a property, an adjustable rate mortgage. I knew it wasn't the best loan to get, but when I got it 4 years ago, I knew I had 5 years to figure it out, but I didn't want to lose the deal. So that's what I did. And I literally just got the appraisal and it came back positive. So that's really good. And I'm getting it into a 30-year mortgage, and I'm actually even cashing out a bunch of money. So it worked out great. Now, it doesn't always work out like that way. And just like Jay said, it's individual basis. I don't tell anyone to do the same thing I did. In fact, I don't think it's a great product at all, but I knew that I could get out of it in 5 years. So my goal was to do that. But my question to Jay was, and the reason I asked about the line of credit was I had a line of credit, and that's what I did. I actually pulled a large chunk of it out because I'm under contract on a property that I got 20-30% under market value, but I want to rehab it, and I was going to use my line of credit to do that. And then, COVID-19 hit, and I was scared that the bank might close down my line of credit that I was going to use to rehab that property in 6 months to a year, refinance it, get all the money back out, pay the line of credit. Everyone knows how that works. But, so I in my situation, I felt like it was smart to pull it out. But like you said, I would not advise everyone to do that unless you have a plan financially for that money. Is that kind of what you were getting at, Jay?
Yeah, absolutely. One of the things, like I said, because lending tightens, one of the things we have to make sure of going into a downturn, and whether it's preparing for the downturn before it happens or right at the beginning, it's still, like you said, you're still able to get a loan right now. And I'm sure there are a lot of people that right now are in a better position than they may be in a month or 2 or 6 from now. Now is the right time to be analyzing your portfolio and saying, hey, do I have any loans that are coming due in the next year or 2 or 3? And if you do, now is the time to figure out what is your backup plan when that loan comes due if you can't execute on your plan A. So for a lot of us, that plan A is we're going to refinance. We're going to go to a bank and we're going to either refinance our hard money loan. Maybe our plan A is we're doing a flip, and our plan A is that we're going to sell it. Maybe our plan A is that we're going to find another private lender. Our cousin has money in his IRA, and our plan A is that he's going to lend us the money. Well, now is the time, because lending is going to get tighter and it's going to be harder to find money. Now is the time to make sure not only do you have a plan A, but you also have a plan B, C, and D. So if, let's say you have a hard money loan, and let's say that loan comes due in 8 months from now. So you've been flipping a property, you had a 12-month loan, and you're 4 months in, it comes due in 8 months. Now is the time to go sit down with that hard money lender and say, hey, what happens if 8 months from now the economy gets really bad and I can't repay this loan? Are you going to call it due? Are you going to foreclose on me? Or are you going to extend that loan, maybe make me pay a point or two, maybe raise the interest rate a little bit, but will you give me a backup option to extend that loan? And if the lender says, yeah, I'll definitely extend the loan as long as you're current on your payments, great, there's your plan B. But maybe the lender says, no, you need to pay in 8 months because I need this money for something else. And now you know that you have 8 months to figure out a plan B. And now's the time to start working on it. I know too many people that wait until 3 weeks before their loan is due, 3 weeks before some balloon payment is due, and they say, "Oh no, what am I going to do?" And they go to the lender and they say, "I don't know what I'm going to do." And they say, "Well, why didn't you come to me 6 months ago or 8 months ago?" And so now is the time to really look at your portfolio, look at any loans that are coming due, and not just in the next 3 or 6 months. Remember, a downturn can last a year or 2 or even 3 years. So look at all of those loans that are coming due in the next 24 to 36 months, and make sure you have a plan B for each of them. I make loans these days to people that are doing BRRRR investments. So they're buying a property, they're borrowing money from me to renovate it, put a tenant in with the plan to then refinance with a larger bank. And so what I've done is I've gone to each of those investors and I basically said, look, your loan is due in up to 12 months, whatever it is. It's typically a 12-month loan. But if in the time that loan comes due, if there's a problem and you can't get a refinance, I'm going to be willing to extend that loan. I don't want you to have to stress over that. I don't want you to have to worry about that. As long as you're making payments, as long as you have a tenant in there that you can continue to make me payments, I'll extend that loan for a year or 2 or 3 or 5. I don't care. I'm happy to extend it because I don't have anything better to do with the money. I just loan it to somebody else for the same exact purpose. So as long as they're paying, I'm going to extend the loan. There are a lot of lenders out there that are willing to do that. But I know for me, I like to have a heads up. I like to know what my exposure is. I like to know where I'm going to have to put money or what money I'm getting back. So have those conversations with your lenders now. Don't wait until 2 weeks before the loan is due.
I think that is so important, having the multiple exit strategies. Even not in a downturn, even when the economy is great, if, maybe a flip isn't going to sell, will this property still work as a rental property? So let's talk about strategies that might work in a downturn. So a rookie investor just looking to get started, what would you recommend they get into? Flipping, wholesaling, buy and hold? What strategies would work the best right now?
Well, let me start with the question of what should we be doing today during this pandemic? So during a typical downturn, during a typical recession, I can give you a laundry list of what we should be doing and not doing, and I'll go into that next. But it's worth pointing out that what we're seeing today, right this minute, over the last couple months, is kind of unprecedented. I've written a book on economic cycles and what real estate investors should be doing, and I don't have a chapter in that book about how to invest during pandemics because nobody's really thought about something like this happening.
Especially for buy and holds. I mean, as a buy and hold investor, I thought that I was pretty safe during a downturn, but
I've been saying for a decade now that buy and hold investing is always a safe strategy, but now I have to kind of put an asterisk next to every piece of advice I give that this piece of advice may not hold up during a pandemic. So first thing, if you're looking to invest now, if you're just getting started now, the first thing I would say is don't be impatient. I know a lot of investors that have, for the last 3 or 6 or 12 months, have been ready to do their first deal. They see the market, not necessarily the market dropping, but they see the economy getting bad, and they're thinking, okay, now's my opportunity, and they're ready to rush right out and do a deal today or tomorrow or next week. First thing I would tell them is don't. Slow down. Now is a great opportunity to flush out your business plan, to make sure you know what you want to do, to understand where the market might be headed and what strategies that are going to work and not work. Now's a great time to be studying and reading and learning. Listen to all the old rookie podcasts. Listen to all the old real estate, the BiggerPockets Real Estate podcast. Go read the BiggerPockets books. Now's a great time. Go read the forums. Go read the blogs. Now's a great time to be learning and educating yourself and getting prepared. But right now, today, is not a good time for a rookie investor to actually start buying deals. Unless that deal is so good that essentially nothing can go wrong, now is not a great time to be buying investments. And just proof of that is I've bought many hundreds of investments, and my partners between us, we've bought many thousands of investments, and we're buying very, very, very few investments today because there are so many unknowns. Where we are in the economic cycle is again, it's unknown. We've kind of hit pause on the economy, and when the pandemic ends, or at least when the lockdown ends, something's going to happen. Either we're going to find that we're like in the midst of a recession. We're going to find that we're in the midst of a recovery. Maybe we're going to find we're in the midst of a depression. We don't know. And without knowing where things are going to be in a month or 2 months when everything opens up, it's impossible to know what the right investing strategies are today. So the very first thing I'm going to say is don't be impatient. Don't run right out and do deals. If you're on Facebook, if you're on BiggerPockets, you're going to be reading about all these people that are still doing all these deals. Don't feel the need to keep up with them. Don't feel the need to do a deal just because everybody else is. Now is a great time to sit back, to pay attention, to learn, to prepare. Now, what strategies typically work during a downturn? First thing I'll say, and I know this is going to disappoint a lot of people, flipping tends to not be a good strategy during a downturn. So the entire strategy of flipping relies on buying low and selling high. And when the market's dropping and when values are going down, that selling high piece is pretty tough. Sure, I can buy low today, low relative to what today's resale value is. But if the market's dropping, that might not really be a low number come 3 months or 6 months from now. So what I tell people is, don't buy a flip now unless a couple things. One, you get such a great deal that you're confident you can turn around in 3 or 6 or 12 weeks and still make money or at least break even. Number two, if you're going to buy a flip right now, make sure you keep the project quick. So during a typical recession, at least, it's unlikely that the market's going to drop 5 or 10 or 20% over a month. But it can drop 5 or 10 or 20% over 6 months. So don't do projects that are going to take you 6 or 12 or 18 months to complete. I would tell people don't start a new construction project right now because we have no idea where the market's going to be in 6 or 12 or 18 months when that's ready to be put back on the market. But even a flip, unless you're going to keep it to a month or 2 or even maybe 3 months turnaround, you're taking a big risk. So if you're going to do a flip right now, 1, make sure you're getting a fantastic deal. 2, make sure that you're keeping that deal really quick. Only take the flips that you can get done in the next month or 2. Don't buy 5 flips right now knowing that, okay, I'll get 1 done in 2 months and then I'll do the next and the next and the next. By the time you get around to that 3rd or 4th or 5th flip, the market could have crashed and you're in a bad position.
Before you go on to the next strategy, I just want to mention that if anyone wants to learn a little bit more about flipping during a downturn, I think it was episode 381 on the Real Estate Podcast, where Tucker started talking about speed is your best friend doing a flip during a downturn. So if you guys want to go back and listen to that more. So what's the next strategy you want to talk about? So maybe buy and hold or house hack?
Yeah, absolutely. So let's talk about buy and hold. So buy and hold is one of those strategies that works in any market. And again, asterisk, maybe not so great during a pandemic because there are people not paying their mortgage. But typically speaking, a buy and hold deal, a deal that's generating cash flow every month, is going to be good in every market because even if the value of that property goes down, as long as it's generating cash flow month after month after month, you're going to be in a good position. Typically speaking, during a recession, we might see a small drop off in market rents in some cities, in some states, in some counties. But typically speaking, rents are pretty forgiving and rents tend to stay pretty strong even during a downturn. So let's say you buy a property that you pay $100,000, it's renting for $1,500 a month. If the market crashed and that $100,000 property dropped to a $20,000 property, you don't care. As long as you're still making your $1,500 a month, because eventually that property is going to come back up to a $100,000 property. So the key is that it's generating cash flow to cover whatever your worst case situation is. So what can you do to ensure that it's generating the right amount of cash flow? A couple things I like to suggest. Leading into a downturn, make sure that you factor in when you're underwriting the property. And when I say underwriting, I mean analyzing a deal. Make sure you assume that the market's going to drop or the rents are going to drop by about 10%. Typically, like I said, in most markets, they're not. But the worst case scenario, and I always like to look at worst case scenarios, the worst case scenario in most markets is that rents might drop by about 10%. So if you do your analysis and you assume, let's say rents are $1,500 today, if you assume 10% less than that, if you assume rents are going to drop to $1,350 a month and the numbers still work, then move forward with that deal.
anytime I think you should be conservative when running your numbers and,
Absolutely.
Run your numbers twice, what they are exactly now and what's worst case scenario.
Absolutely. So one, I always tell people, model your deals 10% lower rents than whatever they are today or whatever they were last month. Next, assume that you're going to have higher vacancy. Now, that may or may not be the case. Just like market rents, vacancy tends to be pretty resilient during a downturn, especially in certain markets and certain types of properties. But always assume that you're going to have higher vacancy. You're going to have some units that aren't rented because it's harder to find qualified tenants, or you might have units that are rented, but people stop paying. So even though technically it's not a vacancy, you may not be making money off those units. So I always like to say, model your deals with a 10% higher vacancy. So 10% lower rent, 10% higher vacancy. If the deal still works out with a 10% lower rent and a 10% higher vacancy, buy it. Doesn't matter if we're at the top of the market, the bottom of the market, because again, as long as it's cash flowing, it's probably going to continue to cash flow no matter what the market hands us. And then the final thing I'll say about buy and hold is there are certain types of property that tend to do better during a downturn than other types of property. Did you want to ask a question, Felipe?
Yeah, no, I was interested because all this knowledge and everything that you're putting out, I'm like, okay, this is all really good information. So I'm assuming you were a pro with your very first property too, right? With your very first deal, I'm assuming you totally hit it.
Oh no, we should talk. We should talk about my first deal after this. Let's talk about that.
After this, let's get there because I know our listeners are going to be dying to hear about your very first deal.
Yeah. Okay. So real quick, last thing I'll say about buy and hold though is the type of property you buy is going to impact its performance, is most likely going to impact its performance during a downturn. There are certain types of properties that tend to perform better. And it makes sense if you think about it. When people start losing their jobs and getting their hours cut and getting their wages cut, they're making less money and they're not looking to make extravagant purchases. For that reason, we tend to see a lot of people that are renting that A-class housing, those really nice apartments or those high-end houses. They tend to decide, okay, I'm going to save my money. I'm going to be a little bit more frugal. And the people that are renting those really nice A-class properties tend to move down into like the B-class properties. So they might move from an apartment complex that has like a really nice gym and a pool and a concierge and a Starbucks on site to a decent apartment complex that might have a decent gym and a smaller pool or whatever. They're going to move down in class. And then those people that were living in those B-class properties, a lot of them are going to be frugal as well. They might lose their jobs, they might get their hours cut, and they're going to decide, I need to save money. So what they're going to do is they're going to move from that B-class housing down into C-class housing. A lot of people in C-class housing, well, most people aren't going to go homeless, so C-class housing is going to tend to be pretty resilient. In fact, during a recession, C-class housing, those kind of that working class blue collar housing tends to perform very well. Sometimes those values go up and the rents go up. Likewise with mobile homes. Mobile homes tend to kind of be the lowest tier where people will settle in when they start losing their jobs or they're trying to be more frugal. So typically mobile homes tend to do very well during a downturn. So one of the things I tend to tell people is if you suspect a recession's coming or if a recession's here and you're looking to buy a safe buy and hold deal, focus on mobile homes, focus on C-class properties, focus on maybe B- class properties, but stay away from those A-class and those B-plus class properties because those are the ones that are going to tend to perform the worst during a downturn.
That's exactly what my most of my portfolio is that way. It's just a very C plus, B minus, blue collar, hardworking dudes, and they're doing just fine. I've yet to have somebody miss a rent payment. If anything, I've had people pay me a month or two in advance because they want to make sure that they still have their spot at our house. I've also had a whole bunch of people start calling me regarding, rooms to rent or apartment basements that we have for rent as well. Cause I think they're just like not wanting to pay that really high rent for the next 6 months to renew their lease. They're like, well, maybe I'll go to, a 2-bedroom, basement that I've built out or something like that. And I'll wait this out just to kind of see what happens. So I've had, a ton of calls actually going forward from there.
I've had people say that they wanted to buy a house and were going to end their lease, and they've actually are going to wait now to purchase property, and they've asked to go month to month on their lease renewals.
There's definitely opportunity in the lower class housing. To be honest, I've stopped investing in other people's deals at this point over the last year and a half. But the one deal that I have invested in over the last year and a half has been mobile home parks. I have a friend, and I don't want to say his name, although we all know him.
I was just going to say someone who has created all this rage about mobile home parks.
yes. But I love. I mean, it's Brandon Turner, and Brandon I trust more than anybody. But I just absolutely love that strategy. He picked the perfect strategy at the perfect time.
Yes, the timing too.
Timing was absolutely perfect. So, and then there are other things that perform well during a downturn. If you're in the commercial space, self-storage tends to perform pretty well because when people are moving from their A class to B class to C class housing, they're typically also downsizing. But people don't like to throw away stuff, so they put their stuff in storage. So storage tends to do pretty well during a downturn. If you're into like the commercial retail stuff, like grocery stores and retail strip centers that have groceries in them tend to do well. Medical centers tend to do well. So there are definitely a lot of classes of real estate that are what we refer to as recession resistant, which means they tend to do well, or at least much better than other classes of real estate during a downturn.
That's a whole lot of information that's really good. And personally, I know that I'm going to go back and re-listen to that like last 20 minutes and just kind of take more notes. But let's pivot a little bit. And assuming you didn't have all this knowledge when you did your very first deal, so let's dig into that. Let's dig into Jay Scott's very first deal. How did that come out? Was it during a downturn, during an upturn? I mean, give us the dirty on it.
I love this because I can't even tell you how many podcasts I've done, and I've talked about so many things, and nobody ever asked me about my first deal, at least not in any detail. So this is good. This will be the first time I'm talking about this in detail. So
this is exclusive, Jay Scott, exclusive
Jay Scott
interview.
Yes, and so everybody's heard about all the things that go right with my investing. Well, let's talk about this first deal and all the things I did wrong, and I did a lot of things wrong. So first of all, I give my wife full credit for me doing that first deal. We had looked at maybe 100 houses, and I was terrified to pull the trigger. What
were you doing before this? And
good question.
What made you want to jump into real estate real quick?
Yeah, so my wife and I were in the tech industry. We were working full-time jobs in California. When we decided to get married, we were both working like 100 hours a week, and it just wasn't sustainable. So when we decided to start a family, we literally just quit our jobs. We moved from California to the East Coast, and we said, we're going to figure something else out. But we had no idea what that something else was. We weren't planning to be real estate investors. And while we were trying to figure out what to do, my wife just kind of one day said, let's flip a house. And I thought she was nuts because I am not a handy person. I can barely change a light bulb. But I still wanted her to marry me, so I wasn't going to say no.
Attaboy.
Yeah. So it was spring of 2008, and we started looking at houses. I jumped on BiggerPockets for the first time.
Wait, did you say spring of 2008?
Yeah, did you say 2008?
2008. Not only spring of 2008, spring of 2008 in Atlanta, Georgia, which if you look at the data, was one of the hardest hit cities in the country during the downturn. So it ended up, in retrospect, being pretty good timing. But I'll tell you, if I knew more when I started, I would not have started then and there. Yeah. So it worked out, but only because of my my stupidity or at least my lack of knowledge and experience. So spring of 2008, we start looking at houses. We found a wholesaler in our area that wanted to show us houses. So I thought, oh, great. Somebody's going to teach us how to do this. Somebody I can trust. It wasn't quite that. But so we looked at maybe 100 houses between May of 2018 and July of 2018. Literally, every day we would go out and look at houses, and every day we'd say, no, I'd find an excuse not to do it. So July of 2018, and my wife said, we are buying a house. I'm not going to let you put this off any longer. The next house we see, we're buying. And I didn't think she was completely serious. So I said, sure, great. Next house we see, we're going to buy. We saw this house. It was probably one of the uglier houses I've ever seen, but we got done looking at it, and my wife said, we're buying it, to the wholesaler. And he was thrilled because he had just shown us 100 houses. I was mortified because I wasn't ready to buy. I just wanted to put it off. But I certainly didn't want to buy this particular house. And I'll give my blog site later where you can go kind of actually look at all the pictures and see all the details of this deal. But basically, this was this 2-story house. There was like 30 steps you had to walk up to get to the front door. It had no garage, so you literally had to walk up 30 steps to get to the front door. There was bamboo growing in the backyard, completely overgrown. I mean, the house was just really ugly, and it was on a really big lot, so that was nice. But it wasn't a house that I imagined like for my first flip. But my wife said we're doing it. We negotiated a little bit with the wholesaler, and we came up with our numbers. And so it was a $63,500 purchase price for this house. I walked through to do the rehab estimate, and I remember walking through the house, looking around and thinking to myself, I have no idea what I'm looking at. Like, what am I supposed to be writing down? What questions am I supposed to be answering? Like, how do I know what needs to be done and what doesn't need to be done? I remember walking into the bathroom and pointing to in the shower, the grout lines in the shower were black. And I said, I think this house has mold. And honestly, I thought that's like, we're going to have to get like mold testing and mold removal because the grout was black. Like that's how little I'd paid attention to my own house, which was probably 10 times more disgusting, at least till I met my wife. So I had no idea what I was looking at. I had no idea what questions to ask. Somehow I came up with the number $30,000 for this rehab. No idea how I came up with that number. And then I said, everybody was telling me, well, you have to be conservative. So I said, okay, I'm going to add 10%. So $33,000 was my rehab estimate. Now, in retrospect, here we are 12 years later. I've written a book on estimating rehabs. I know what things cost. That rehab is probably a $70,000 or $80,000 rehab.
Wow.
So that's just kind of a preview of where we were. Okay, so $33,000 was my rehab estimate. I assumed I would hold this property for 3 months. We were paying cash, so we didn't have many holding costs, which was good. But we had property taxes, we had insurance, all that. But I assumed 3 months, and I figured 3 months is plenty of time to get this thing renovated and turned around and resold. No problems there. And then we came up with a resale value of, I think, $130,000 or $135,000. So purchase for $63,000, put $33,000 into it, so that's $93,000. I think I had like $15,000 in holding costs, that's $108,000, and resell it for about $130,000. So that's about $22,000 profit. I was thrilled with $22,000 profit. Turns out that, one, we paid too much. So $63,500 in retrospect, we probably should have bought this house for $30,000 or $40,000. There were other houses that were very similar that we later learned were selling down the street for like $20,000 less. So we overpaid just based on the comps. Two, we started getting our rehab estimates, and I mean, I was getting estimates between $60,000 and $150,000. So I had no idea, like we were going to lose money from day one just because I underestimated the rehab, and we can talk about that in a second. So we made a mistake on the purchase, we made a mistake on the rehab. On the resale, so
you're saying the next house we see we're buying is not a good strategy to start with?
Not necessarily a good strategy, though. Yeah. I will get to the good part of that. The good part of that is if we had not purchased this house, it's very possible we never would have bought a house. Yeah, so I do give my wife credit that she made us kind of jump off the cliff.
You finally took action.
We finally took action, and probably not the best property, but it was better than not taking action. So we made a mistake on the purchase. We made a mistake on the rehab costs. We assumed it would take 3 months from purchase to sale. I think even in a good market as a first-time investor, even in a great market as a first-time investor, a full rehab, you have to allocate more than 3 months. This was 2008. I mean, we should have allocated 9 or 12 months of reserves. So we made a mistake on the holding costs. And then in retrospect, that $130,000, $135,000 resale price was actually closer to $115,000 or $120,000. So we literally made a mistake in every number on this flip. All 4 areas, purchase, rehab, holding, and sale, we made a mistake. Now, what did we do? So we got into this. I ended up finding a contractor who said, I can do all of this for $30,000, no problem whatsoever. single guy who had his own tools. He was like, I can do everything from the roof to the plumbing to the flooring. I was thrilled. He was doing this for $30,000.
That just sounds like a bad tattoo waiting to happen there, buddy.
Oh my God. So first lesson for anybody out there that's getting ready to do their first flip, don't hire somebody that says they're going to do all the work themselves. First, they're not going to have the skills to do it. Nobody is, I mean, you can be a jack of all trades, but you don't want a jack of all trades to do a retail flip. People aren't going to see past those types of problems. So finding somebody that says they're going to do it all first, they're not going to do a good job on all of it. Second of all, they likely are not going to estimate the cost of the job correctly. Typically, those people are going to go in with rose-colored glasses. Yeah, I can get this done for $30,000, thinking, if I get it done for 50 or 60, that's great. I, as the investor, I wasn't expecting that 50 or 60. I was expecting 30. For them, it was kind of like, yeah, I'll try and get it done for 30. They're not the type of people that use the software to create their rehab estimates, and they track everything in Excel and they know their costs. They're just throwing out a number. And then number three, if you find somebody like that, you're probably going to wait 3, 6, 9, 12 months for this rehab to get done.
So especially if they're doing everything themselves. And then when you start asking them, hey, I thought like this is taking a long time. Can you bring in somebody to help you? Sure, I'll bring in somebody to help me, but then it's going to get really expensive. So first lesson I learned in this business was the jack of all trades contractor is probably not the right kind of contractor for your jobs. So anyway, long story short, this flip took us 3 or 4 months, should have taken 3 or 4 weeks. We actually did get pretty close to budget, though. If I go back and look at our scope of work, I mean, we had an 18-year-old HVAC in there that we didn't replace. The roof was close to 20 years old. We didn't replace it. So we took a lot of shortcuts. Again, we made essentially every mistake we could make. We threw the property on the market at, I think, 125 or 130. We got one offer that fell through. I got really scared and said, oh no, we're never going to be able to sell this property because it had been on the market for 3 weeks. This is 2008 when 6 months was probably the right amount of time. So I got really scared. I said, we're not going to sell this. Let's just rent it out. So long story short, we got a lease option tenant in there. They stayed for about 2 years. They destroyed the house. They left in the middle of the night one night. I mean, we only found out that they left when we got a call from the police that there had been a break-in at the house, and we realized they had probably been gone for 2 or 3 weeks at that point. And so we did a complete second rehab. At this point, we had done like 30 or 40 renovations. So we were ready for it. We did a second rehab. We put it back on the market. We put it on the market at a good price. We got a quick sale. We ended up making $1,200 on this deal. So it was.
What is that per hour worked? I mean, what was your hourly?
There is zero chance I made minimum wage. So, but I look back and I think to myself, okay, it took 3 years. I made every mistake I can make. I probably literally made less than minimum wage. I probably made $2 or $3 or $4 an hour. Ridiculous amount of stress, ridiculous amount of headaches for this deal. But I look back, I made money. I made $1,200. And so what I tell people is be conservative, because that's the only reason that we made $1,200 was because even though we overpaid, I still assume 63 was a low number. Even though we misestimated the rehab budget, I still assumed in my calculations that I was going to have a decent amount of profit. So if I ate into that profit for the rehab, I'd be okay. So every step of the way, I miscalculated the numbers, but I was conservative still. And so the fact that I was conservative allowed me to kind of make every mistake on the book on that first project and still make a small profit.
So it sounds to me like you learned all of the lessons that we real estate investors learn in that one property. Sounds like you just learned everything in one property. But what I'm also hearing is you took action. Yeah. You took on a project that was out of your comfort zone.
Yep.
I mean, we even still made money proving that real estate's forgiving.
Yep.
It seems like you learned a lot during this process, but more importantly than all of it is you took action, which has trajectored you to where you're at now.
Absolutely. And that's the thing that I tell everybody is that at the end of the day, there's nothing, I'm not telling anybody to jump in without learning, without researching, without listening, without reading, without talking to other people. But at some point, you're going to know that you're ready. And you're going to know that you're just delaying because you're scared. People know that. I've talked to enough investors that when I say to them, do you feel like you don't know enough? Or do you feel like you're just too terrified to take the next step? 99% of the time, that investor knows the difference. I mean, we always think, I'm not sure that I know enough, but if you really are honest with yourself, you know if you've studied enough that you're kind of ready to take that next step. And so what I say to people is have that conversation with yourself or with your spouse or with your partner and be completely honest. Am I not buying a deal because I feel like I'm not ready, I don't know enough, or am I not buying a deal because I'm just scared to take that leap? And if you can be honest with yourself, and most of us can, if the answer is I'm just scared to take the leap, well, you've done the hard part. You've come to that realization that this is what's stopping me, and you no longer have that excuse that I haven't learned enough or I'm going to do it next month or next year. You have to accept the fact that because you've said to yourself, because you've admitted to yourself that you're just scared, you have to accept the fact that you're either going to do a deal soon or you're never going to do a deal. Here's one of the big secrets that I learned in real estate, and I try and tell this to everybody that's kind of in that analysis paralysis phase. I meet a whole lot of people out there that fall into one of two categories. Either one, they've done 0 deals. They read and read and read and study and study and study, and they never actually pull the trigger. That's probably about 90% of the people I meet. Then there's the other 10%. Those are the people that have done 2 or 3 or 5 or 10 or 50 or 100 deals. You know what type of people I never ever meet? I never meet anybody that's done 1 deal. Do you guys know anybody that's done 1 deal and stopped?
That is such a good point. Because I don't, and the whole time you've been talking about this being scared, I've been thinking of how people have said, they have fear, they're afraid to do it. But look at you, almost worst case scenario, like a lot of bad things happened in that first deal, and look at how far you've come now that you can get over those challenges. And sometimes those are the most successful people that have failed in the beginning, and it just helped them overcome those hurdles and be stronger in the end.
Yeah, people have to realize nobody does 1 deal, because once you get that first deal, it gets 100 times easier. The second deal is so much easier than the first, and the third is so much easier than the second. And after you get that first deal, everything kind of clicks into place. You realize, like I said, when I walked through that first house and I said, I don't know what I'm looking at for the rehab estimate, after doing one rehab, the second house I walked through, I was just like, okay, I know what I'm looking for. I remember on that first house, the flooring was crap. I had to replace the flooring, and I had to redo the tile here, and maybe I should check the plumbing and see if that's working. And I knew all the questions to ask. Yeah. So that second deal was so much easier. So what I tell people is, if you're terrified, just do that 1 deal. Because I promise you, if you don't give up and you do that 1 deal, before you know it, you're going to realize that you've done 5 or 10 or 500 deals.
That is such great advice. And I hope that our rookies listening will take that advice and take action. And you do get addicted once you get that first deal done, and it does become easier. So we have a segment, it's called the Rookie Request Line, and a rookie calls in, and we hope you can answer a question for them. And if anyone else would like to call in, and we'll play your voicemail on the phone or on the podcast, you can call 1-888-5-ROOKIE and leave us a voicemail.
Hey guys, my name is Jake Myers. I'm from Redding, California. I'm looking to get into another rental property. So my question is, are you guys waiting to see what happens, or are you guys continuing to purchase more real estate? I'm kind of worried that the stimulus package is going to inflate the economy and raise prices. On the other hand, I'm worried that this is going to lower prices, so I should wait. Just wondering whether I should wait or pull the trigger.
My answer is, to anybody out there that feels like they need to ask that question, should I wait or should I pull the trigger right now? if you're not experienced enough to make that determination on your own, the most likely answer is you should probably wait. Right now, like I said earlier, right now is kind of an unprecedented time. Things are a lot different than they've ever been. And there's no shame in saying, hey, I don't know what's going to happen. Because let me tell you something. I get to talk to some of the best investors in the world, some of the most experienced investors in the world. And the thing that I've realized is none of us have any idea what's about to happen next. I mean, I've talked to people who think literally in 3 or 6 months, we're going to be at an all-time high in the stock market. Real estate prices are going to go up. Then I talk to people who think in 3 or 6 months, we're going to be in a depression greater than 1930. So even the best investors in this business can't agree on where things are going. So for anybody out there that's confused and they don't know if now's a good time to buy, you're not alone. I don't know if now's a good time to buy. So what I would tell those people, though, is it's not a time to curl up in a ball and kind of run away from what's going on. Now's not a time to sit in front of the TV and just say, okay, I'll think about real estate again in 6 months. Now's the time to start reading and studying, create your spreadsheets, go look at 20 deals and run the numbers so you get better at running the numbers. Go figure out how to expand your credit lines. Go figure out how to save cash. Go find partners. This is something I'm telling a lot of people. During a downturn, if the market gets bad, one of the nice things about a bad market is there's going to be a lot of opportunities. But for new investors, it's hard to take advantage of a lot of opportunities at once. And so if you want the best chance to be able to take advantage of multiple opportunities, build a great team. So go find a partner, go find somebody that's good at acquisitions, go find somebody that's good at raising money, go find somebody that's good at managing renovations or good at estimating renovations. Go start putting together a team so that if some great deals start to present themselves in 3 or 6 months, if we have some great opportunities, you're going to be ready. So now may not be the time to go out and be spending money actually closing on a deal, but certainly now is a time to be working on your real estate business.
That's a great point about building your team too, because now is the time to watch those professionals and see, who is excelling during this time, who has, their stuff together, your CPA, your, lawyer, your realtor. How are they handling everything that's going on right now? And that could really determine if you want to continue to partner with them or maybe form new partnerships with the people on your team.
Absolutely.
No, yeah, that's absolutely right. I'm definitely myself looking at my team and seeing how people are reacting, including my realtor, my CPA, and what they're doing during this time, because that's going to tell me if I should keep them on board, going forward past this. Are they positive, negative, what's going on? So I'm really looking at my team right now, and I think everyone should. Jay, before we get to our some of our funner questions going forward, I did want to ask you one more thing. Where do you think the market will be through the rest of 2020?
I am happy to give I'm not even going to call it an opinion. I will call it a guess. I already said earlier that anybody that tells you that they know where the market's headed or how good or bad it's going to be is just making stuff up. So let me start with what I'm about to say. I'm just making stuff up. This is my guess based on data that I've seen and where I think that data could lead. This is my guess based on trends that I've seen, people I've talked to. But here's my guess. I think at some point in the next month or so, hopefully, we're going to, for the most part, get out of this lockdown. And once we get out of this lockdown, I kind of use the metaphor. We're kind of like we've run off a cliff and we've dropped down to the bottom of the cliff. And at the bottom of the cliff, there's a trampoline. And that thing that's fallen off the cliff is the economy. And so the economy goes all the way down, like as bad as it can get. It hits a trampoline at the bottom. And when things open back up, that trampoline kind of pushes the economy back up. Now, anybody that knows physics knows that when you bounce on a trampoline, if you don't add energy, you're never going to get back to the same point that you started at. So you'll never get back to the top of the cliff. The question is, how high back is that is the economy going to bounce? Is it going to get close to the top of that cliff? Is it going to get only about halfway? Where are we going to settle in once that initial bounce after the lockdown kind of takes hold? My take is that we're going to settle in a place that looks like a typical recession. So we're going to have decent unemployment. There are a whole lot of people that are not going to get their jobs back after this, unfortunately. A lot of businesses are going to go out of business. A lot of businesses are going to slow down. There are going to be fewer people traveling. The tourism industry is probably going to take a hit. People might be going to like the beach, their local beach, but people aren't going to spend necessarily $10,000 to go to Disney World after this when they don't know what's happening with the economy. So I think that we're just going to see a general slowdown in the economy over the next 3 to 6 months. We're going to see what's basically a typical recession. And then in 6 months, we could go one of two ways. I think things could either start to get better and we could come out of that recession the way we typically come out of a recession, or we could see what ends up being a very, very, very bad downturn. Now, there are 3 things that I think will play a part into which way we go. So like I said, next 3 to 6 months, kind of typical recession. And then from there, it branches off, either better or worse. And the 3 things that I think will ultimately determine whether it gets better or worse are, number one, there were a lot of things in the economy that were not looking great leading into this pandemic. The economy was pretty strong. Stock market was great. Unemployment numbers were great. Everybody knows that. But there were certain other numbers that were less strong. We were cutting interest rates, and manufacturing was kind of in a slump, and retail wasn't doing great, and wages weren't really keeping up with inflation. So a bunch of economic numbers that were just less than stellar. So it's very possible that this pandemic kind of exacerbates all of those things that weren't looking great before. So if the whole interest rate situation ends up being really bad, leading into this pandemic, interest rates were in a bad place. That could kind of cause a whole bunch of different industries like manufacturing and retail and tourism. It could cause those industries to kind of snowball, and it could cause everything to kind of just go out of control. So basically all those economic indicators that weren't great leading into this could get a whole lot worse. So that's number one. Number two, the government is spending literally trillions of dollars. It could be $5 or even $10 trillion before this is over to kind of keep the economy going. That's a necessary thing. I mean, nobody likes having to spend $5 trillion to print money, but it's, in this case, I think it's an example of a time when it's absolutely necessary to do. The question is, what is that going to break? How is spending $5 trillion or $3 trillion or $10 trillion over a few months, what does that break in the economy? We've already seen this whole thing in oil. So for anybody that hasn't been paying attention, basically oil prices for crude oil have gone negative, something that's never happened before. Nobody could have predicted.
Who would have thought that would have happened?
I refer to it as an unintended consequence. The mortgage industry, we've had a lot of issues in the mortgage servicing industry because of the forbearances and because people are being told they don't have to pay their mortgage or pay their rent. So that's an unintended consequence. What are these other unintended consequences besides oil, besides the mortgage industry, that all this stimulus breaks? Is there something really, really big that happens that we break that just destroys the whole economy? We don't know. So that's number two. And then the number 3 question that we don't know the answer to, so we don't know if things are going to get better or worse, is what's going to happen with future lockdowns? So we could come out of this lockdown for this pandemic next month, and everything gets better. We find either a vaccine, or we find a good treatment, or we find out that 90% of the people have already gotten it, so we're mostly through it. And that's a good scenario. The bad scenario is what happens if we don't get a vaccine, if in 6 months we hit the fall and the virus comes back really hard and we have to go into a second lockdown or a third lockdown or a fourth lockdown. That can derail the economy again. So at the end of the day, the risks are all the things that were kind of not great in the economy leading into this pandemic. Those things can break. All the stimulus that the government's releasing during the pandemic, that could break something. And future lockdowns, that could really derail the economy again. If any of those 3 things happens and kind of cascades and dominoes, I think we could see a major, 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 major downturn. If none of those 3 things happens, if we get really lucky, then I think people are right. What we might see is we see a typical recession, and then in 6 to 12 to 18 months, everything's back on track again.
Thank you for sharing that with us, Jay. I think it's always interesting, at least for myself, and I think our listeners too, is hearing, someone's perspective and your guess on what could be the future, because I think that's what everyone is wondering now is what is going to happen. And, hopefully it will help them make a decision whether they should, continue to invest, keep investing. But really, everyone needs to make that decision for themselves. And I'm really glad that you had brought that point up too. And we did mention it a little bit earlier, but you did write a book about this for anyone who wants to read it, that, wants to find out some more information about understanding the economy and how these cycles work. Can you tell us a little bit more about that?
Economics has always been a passion of mine, and real estate has always been a passion of mine. And I realized about a year and a half ago that there were no good books out there that talked about economic cycles and the economy and how it relates to real estate and us as investors. So I wrote a book called Recession-Proof Real Estate Investing, and it is basically all about how the economy works, all about how economic cycles work, and then all about the whole second half of the book is how us as real estate investors, we should be modifying our strategies and our tactics to ensure that during any part of the economic cycle, whether it's up or down or flat, that we're maximizing our profits and we're minimizing our risks. And so that was released about a year ago through BiggerPockets, again, Recession-Proof Real Estate Investing. And then just this week, they released the paperback version. So I'm very excited about that.
And that has an updated intro.
It has an updated intro, and actually it has several sections have been updated. I wrote the paperback version just at the beginning of the pandemic, beginning of March. So I updated a few sections just related to some of the new information that we have.
So if you want to purchase that, you can go to biggerpockets.com/recession. And if you buy it from there, there's also a lot of freebies too. You have some guides that you're giving away with that.
Yep, there are a whole bunch of bonuses. There is a couple Q&A conferences that I did live with some investors, and I think they're releasing a couple other bonuses. I don't know exactly what they are, but there are a couple other bonuses there too. But what I would tell people is if anybody gets the book and is reading it, what I would suggest is over the next 3 to 6 months, assume that we are in the recession phase of the cycle, and those are the strategies that you should probably be considering most seriously at this point.
Well, yeah, so if you guys want to check that out, biggerpockets.com/recession. And now we have some fun questions to ask you.
Let's do it.
Felipe, you want to take the first one?
Yeah, absolutely. So what's a quote that sums up your approach to real estate? You've been doing this for quite some time. You've been gone through a couple of recessions and ups and downturns, and hell, you wrote the book on it, right? So what's one line or quote that you just live by when it comes to this now?
I'm a big fan of Warren Buffett's famous quote of Rule 1 for investing, don't lose money. Rule 2, see Rule 1. Not the exact words, but I'm a big fan. I'm a very conservative investor, and I think that's actually one of the reasons why my wife and I do so well working together is that she tends to be a lot less conservative, so she kind of pushes me out of my comfort zone. But I credit a lot of my success to the fact that I'm very meticulous about the numbers. I'm very conservative. I don't take a lot of risks. I'd probably have a few $1 billion more if I were less conservative, but I'm happy to
it helps you sleep at night too. I
like to sleep well at night. Yes.
Okay, so my question isn't really on our list that we choose from, but I am curious as to what are you doing for your kids, if anything, to involve them in your real estate business, and are you trying to build a legacy for them?
Well, starting with the second question, no on the legacy. I think a lot of people like to push their kids into what they do. I would love my kids to be entrepreneurs. I would love my kids to be investors, but I'm also realistic enough to know that if I don't push them, they'll probably find other passions. So if what I create ends up being a legacy, if they end up taking over any of our businesses, whether it's our real estate business or any of our other businesses, that would be awesome. But I like to kind of build on the assumption that they won't, so that way I won't be subliminally or subconsciously kind of pushing them to do that.
Yeah.
I want them to kind of follow their own path. That said, I find it very important that our kids kind of understand money and understand investing, understand the way capital flows through markets. I guess that's a complex way of saying we just involve them in our investments constantly. So our kids went to their first closing. Our oldest went to his first closing when he was 6 days old.
Oh, yeah.
And
That's awesome.
Got to start them young.
yeah, absolutely. He is on every job site with us. I mean, we don't go to the job sites anymore, but for many years, they were on every job site with us. We don't do a deal, whether it's a business deal or a real estate deal or any other deal, that we won't sit down as a family and talk through the deal. It's something my wife and I like to talk through all of our deals, but we like to involve the kids. So we'll actually walk them through. This is how we do the numbers and let them ask questions. And you'd be surprised. I mean, even at 9 and 10 years old, they often ask insightful questions that get us to think.
Oh, I'm sure. Yeah.
Yeah, and then we try and do things kind of the formal way, and I'll explain what I mean by that in a sec. Every time we do something, so my kids wanted to start a lemonade stand last year, and instead of just doing the here's some lemonade, here's a table, go sell some lemonade, my wife and I kind of did the more formal thing of, okay, well, let's talk about how much it's going to cost to start a lemonade stand. So what are the things we need? What are the ingredients? What are the cups? What's the signage? What are the tables, and where are we going to get that stuff? And for the stuff we have to buy, how much is that going to cost? And you guys don't have any money, so how are you going to pay for that? Well, how about if mom and dad loan you the money? And then we go out together and you can pick the kind of lemonade you want to buy, and you can pick the kind of cups you want to buy, and we can talk through how we want to price that. And you guys make all the decisions, whether they're good decisions or bad decisions. We'll figure that out later, but you make all the decisions and we'll loan you the money. And then they did their lemonade stand. And at the end of the day, we counted all the money, and I said, well, we loaned you this much money, so you need to give us that much money back. Now let's
Plus
see
interest.
how much. Yeah. Well, we hadn't started interest yet.
Oh, you didn't do the interest.
But we did that separately. So they returned the money, and we actually create a P&L, an income statement. So it was like, here's our gross revenue, here's our cost of goods. So here's the amount we spent on cups and lemonade. Here was our expenses. Here was the amount of money we had to pay mom and dad back. And then here was our profit at the bottom. And so from a very early age, they realized that just because they make $20 or $30 at the lemonade stand doesn't really mean they make $20 or $30. And they were really disappointed that first time to find, we have to pay back the $20 that we borrowed from mom and dad. But at the end of the day, they made some money. And the same day they did their first lemonade stand, I think they had like $35 or something. I said to them, how would you like to invest that money? And they said, well, what does that mean? And I said, well, this is the way it works. If you want to give me that $35, what I will do is I will give you $3 for every month that you let me borrow that money. You don't have anything to do with the $35. You're just going to put it in the bank. But if you give it to me to use for whatever I want to use, I'm going to give you $3 every month, or it was $3.50 because I did 10%. I'll give you $3.50 every month. And then in 6 months, I'll give you the $35 back. And so they were like, I don't know. Okay, sure, we'll do it. I sort of pushed them to do it. And I said, but if we're going to do this, we have to make it formal. So I made them write up a promissory note. Mm-hmm. So I, Chase, and Cade are loaning mom and dad $35 at 10% interest for 6 months, blah, 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 blah. And I said, okay, every month I need to give you the money. If I don't give you the money, you get interest or you get a penalty. Yeah. And so every month they get really excited because now they're up to like $600. So they're taking their birthday money, they're taking their lemonade money, and they keep giving me this money, and I'm stuck paying 10%. Yeah. I mean, it's crazy. And I think they've realized that they're taking advantage, but they still do it. And so every month, basically that's more than they'd get from an allowance.
Yeah.
And so we basically treat money the same way it's treated in the real world. We don't just give them money like an allowance, because in the real world, you're not just given money. If they want to help us with a project, they get paid to solve problems. They don't get paid hourly. So you come up with a good idea that generates money, well, you get a commission off that.
Yeah,
so
that's a great idea.
Yeah, just like the real world.
And with them giving you their money, that's saving that money too, instead of them spending it.
Exactly. So so we treat our kids like we would business partners.
I love that you're still incorporating them in the business, but not really forcing them to do anything that's out of what they would like to do. And then they're making money. They're kind of seeing how it works with $1 or $2 here and there. I can't wait to see their faces when you start showing them what taxes is going to look like. So that'll be a follow-up one.
We've talked a little bit about taxes. They haven't incurred that penalty just yet.
That'll be a great one to see when you have to pay them back all that interest.
If you want to walk in the hallways of this house, you have to. If you want to use the common areas,
exactly,
you got to pay a tax.
That's hilarious. So, what is? I guess for my question, what next would be, and this is going to be kind of away from real estate a little bit. What's a bucket list item that you still want to cross off? It sounds like you've done a great in real estate. You've done a lot. You're now in mobile home deals. You're here, you're there. But what's something that like you would want to cross off your personal bucket list?
It's so funny. I don't have any one or two things.
Jay Scott's done it all.
No, I haven't done it all, but I certainly haven't. There's so many things I want to do, but it's kind of like, if they don't happen. So my wife and I would love to spend a couple years living abroad. So we've talked about moving to Italy. Like, we'd love to live in Italy for a couple years. So I guess that's kind of big on our bucket list. Do we do it with the kids, or we wait till the kids are out of the house and then we do it? I don't know. I'd say that's probably our biggest thing. We lived in Northern California for a long time. Love Northern California, so we'd love to retire eventually to Northern California. So wine country, but those are kind of the two big things, and anything else I don't want to say we're simple people. Like, we like things, but it's it's for us just spending time together as a family and being able to do like our little vacations. I mean, we take weekend trips all the time, and for us, like, that's just the best thing in the world. So,
if I can add something to that, Jay, and this is going to go a little bit off the course here. I've noticed so much happiness in people that take weekend trips. We've started to do that. Something about taking, instead of like, oh, I'm going to take one vacation at the end of the year. I've heard a lot of people that are just really happy and they just take weekend trips all the time.
I find those big trips, like the thought of like going to Disney World or something, that's just horrific to me. It's exhausting. It's exhausting. Like, my kids, they're just as happy. I mean, they're 9 and 10 years old, but they're just as happy. Like, if we like went to California, like, they'd be just as happy driving down the street and getting a hotel down the street. Because for them, it's like, it's the staying in a hotel, getting to do the pool, going out to dinner. Like, that to them, they don't care if we're in California or if we're in Europe or if we're like in the next town over.
They're happy to be with mom and dad, man.
And so for us, I mean, it's like, we live in Florida. We live basically a couple miles from the beach. So for us, like, every day is a vacation. So no complaints, and we're happy.
Nice place to quarantine.
Yeah, it is. It has been.
Thank you so much for providing so much valuable information to everyone and getting that exclusive on your first deal. We feel privileged.
Absolutely. This was so much fun. Thanks, guys.
Yeah. Can you tell everyone where they can, find out more information about you and possibly reach out to you?
Absolutely. So my wife, Carol, and I, first and foremost, are the co-hosts of the BiggerPockets Business Podcast. So for anybody out there that wants to learn more about business and being a business owner, and remember, if you are a real estate investor, you are a business owner. And so we talk all about how to be a better business owner, whether it's real estate or any other business you could have. So check out the BiggerPockets Business Podcast. On BiggerPockets, I am Jay Scott. On Facebook, I'm Jay Scott Investor. And anybody can reach me via email anytime. My email address is the letter J at jscott.com.
And you need to promote your Instagram because we're big Instagram people here
Oh,
too.
yeah. So I'm up to like 3,000 on Instagram. And
That's good.
It's just taking me a long
go.
time.
You're going to catch up to Felipe.
Yes. I'm trying to catch up to Brandon Turner. He's at like 120,000 now. My Instagram is jscott_123flip. And actually, I guess I'll mention this. If you go to my website, I haven't updated it in years, but I started running a website in 2008 called 123flip.com, and there I detail in gory detail, like right down to the penny, our first 50 deals. So if you're a house flipper or you want to be a house flipper and you just want to learn about every mistake my wife and I have made in this business, most of them were made during those first 50 deals. So go check it out.
Yeah, we'll put links to that too in the show notes, so everyone can check it out, and a link to your book, definitely the podcast, because I've listened to a ton of your guys' business podcasts, and you're so right. As a real estate investor, you are a business owner, and a lot of the systems that your guests talk about are very relatable to a real estate investor. Hey, well, thank you so much. I am Ashley at Wealth from Rentals, and he's Felipe Mejia, REI. And don't forget to join our Facebook group, Real Estate Rookie. And do you guys have a business Facebook group?
We are working on a business Facebook group. So
awesome. Well, we'll post about it
soon.
in the Real Estate Rookie one. We'll post it in there so everyone can join that. Hey, thank you.
Thanks, guys.